I'm 𝗃𝗵𝗂𝗀𝗃, a senior analyst at Argus Media. Alongside my colleagues Mina Chauhan and Dylan Koo, I will be discussing the impact of the US-Israel-Iran war on sulphur and sulfuric acid markets. I'll be starting off with conflict-related disruption to supply, followed by changes to trade flows, and then finally touching upon the impact of the conflict to the global sulphur balance. 45% of global sulphur comes from the Middle East, so even if the Strait of Hormuz opens and it's safe for vessels to transit through, it will still take months to years to fix the damage that's been done to gas plants and refineries and to get them back up to regular capacity. All parts of the supply chain have been severely impacted, and there's no equivalent accessible replacement for these tons from any region. Iran has attacked tankers, energy infrastructure, and US military sites across the region, while an Israeli strike on Iran's 𝗧𝗵𝗂𝗄𝗃 gas field loss in March caused substantial damage. Sulphur production facilities that have been damaged also include Qatar's Ras Laffan gas production facilities, which have got sulphur production capacity close to nearly 2 million tonnes per year combined, which represents the majority of Qatar's sulphur output. According to Qatar Energy, normalising LNG output could take at least 3 to 4 months from the end of the conflict. Across in Kuwait, there's KPC's Mina Al Ahmadi and the Mina Abdullah refineries, which have sustained damage and completely stopped operations, and then KPC's Al Zour refinery is also operating at 50%. In Bahrain, the 𝗁𝗃 refinery has sustained severe damage and is expected to be down for some months following the end of the conflict. In Saudi Arabia, the Ras Tanura refinery, the 𝗃𝗶𝗱𝗃𝗀𝗃 oil plant and the Samra refinery in Yanbu have sustained damage, but most of Saudi Arabia's huge sulphur production capacity remains online at 8.2 million tonnes per year. In the UAE, ADNOC's Habshan plant was shut down after falling debris from successful interception of missiles, with a drone attack again on the 8th of April. Operations at the Shah gas plant have been suspended after a drone attack caused a fire, and the Ruwais refinery has lowered utilisation due to an external impact and a fire in mid-March. Over in Oman, the Duqm refinery has lowered operating rates, which is really limiting the 500,000 tonne capacity volumes from the only place that can really export in the Middle East. So this means that sulphur is essentially entering a two-tier market, with fertilizer and metals producers having completely different affordability ranges and potentially curbing demand from fertilizer producers. Fertilizer markets are expected to be the most heavily impacted, with rising costs of other raw materials further tightening margins. Stocks are being drawn upon, and in May, buying for upcoming fertilizer application seasons will begin. Metals producers are less exposed to this risk, with more workable netbacks and additional revenue from other streams to cushion the sulphur price rise. The graph at the top shows the average month-on-month sulphur price changes from Indonesia, and we can see that in April pricing has skyrocketed, but pricing does still remain at relatively affordable levels for Indonesian nickel producers. In the graph on the right, we can see both FOB and CFR pricing has reached an all-time high, with the loss of supply from the Strait of Hormuz severely impacting global markets. At the bottom, we have the sulphur value share of DAP, which is the value of sulphur in 1 tonne of DAP when you look at the cost of sulphur to get to that 1 tonne of DAP, and that's using the prices of each to compare. So historically, an 11% value share has been ideal, with fluctuations around this number, but where it is now at 31% is highly unusual and not really sustainable at all. But what this does is provide us with an indicator that DAP producers may end up with demand destruction or a sulphur price ceiling, whereas metals producers will still be able to afford to be able to buy at these levels, which my colleague Dylan Koo will touch upon later. Essentially, the loss of Middle Eastern sulphur cannot be replaced with anything else, and it will result in a significant trade deficit. So on the left, we can see that 22 million tonnes of sulphur exports come from the Middle East, and they're largely going to Morocco, Indonesia, India, and the DRC. So on the right, we have the latest trade balance forecast, where the market is in around a 230,000 tonne deficit. So the trade balance isn't too significant as it might be with the loss of tonnes from the Strait of Hormuz, because there has been some demand destruction and buyers just aren't importing as many tonnes as they were at the start of the year. Some buyers have been able to import, but the cargoes are very low, the prices are very high, and imports overall do remain low. Larger buyers did already have some stocks, and cargoes from previously agreed deals are still coming in, and burners can also reduce operating rates to limit the short-term demand. Another alternative, which is especially prevalent in Indonesia at the moment, is that regular sulphur buyers can take sulphuric acid temporarily, but in the longer term they will need to take sulphur, and we expect the trade deficit to remain very significant. Currently there are several vessels waiting to exit the Strait of Hormuz, and they're likely to be carrying around 500,000 tonnes to 550,000 tonnes of sulphur, which is trapped in the Gulf. So there's 5 vessels loaded in Qatar at the moment which haven't been able to come out. There's 4 vessels loaded in Kuwait, and there's a couple more vessels in Saudi Arabia as well. Essentially all of these vessels are trapped in the Middle East, and as soon as they can come out, the trade balance will be able to come back into surplus, but at the moment we do expect a long-term deficit.
Hi, my name is 𝗳𝗲𝗂𝘀𝗀. I'm a senior analyst in the battery materials team, and today I'm giving an overview of nickel and its relationship to sulphur and sulphuric acid markets. First of all, very important for context here, is that Indonesia is by far the most important country in the nickel supply chain. It accounts for over 2/3 of mine nickel output and about half of primary refined nickel production. From 2019 to 2025, it really drove global production growth and displaced higher cost producers in other regions. That's across the 2 main sectors that really define the nickel industry. And in terms of overall volumes, that's nickel pig iron and ferronickel for steel applications, specifically stainless steel. And so stainless steel is by far the largest application, but fairly low growth rates in that period, so about 3.5% compound annual growth rate. So Indonesia's growth in that sector has been due to taking share really from those established producers. Batteries are where a lot of the demand growth is. So 23% compound annual growth rate in the same period from 2019 to 2025. And Indonesia captured a very large share of that growth and became a very important part of the battery supply chain for nickel in particular. The main intermediate processes and products used for battery materials are MHP and MAT. So MHP, mixed hydroxide precipitate, is made through the 𝗂𝗶𝗃 process, high pressure acid leaching. And this is the main overall source of nickel for batteries, and particularly well suited for the types of ore found in Indonesia and for the types of nickel that batteries require. An MHP produced through the 𝗂𝗃 process is extremely sulphuric acid intensive, requires somewhere around 25 to 30 tonnes depending on grade per tonne of contained nickel, which is far more than through any other production route for nickel, and pretty much more than anywhere else in the metals universe as a way of producing a metal. It uses a lot of sulphuric acid. MAT is another common route, they're also very popular for making battery materials through. This involves processing through a rotary kiln and electric furnace, and still using sulphur as part of this process, but not a primary agent and driver like it is for MHP. All this to give an idea of just how important Indonesia is in nickel supply chains, and specifically how important 𝗂𝗃 and MHP are for nickel supply chains. Nickel is not directly linked to the war in the Gulf like some other commodities, and there's no major producers or buyers in the region, but for the reasons we've mentioned, sulphuric acid is incredibly important for nickel, and specifically those 𝗂𝗃 producers who are driving a lot of nickel growth. So there's big indirect impacts on the nickel market here. Since the start of the war, prices for Indonesian nickel intermediates have remained completely flat despite the increase in those operating costs. So you can see here the nickel sulphate prices, nickel pig iron, ferronickel. All of these have remained completely flat, and there's been no change in the MHP price, which you might expect to see if those prices are being passed through to consumers. Also further downstream, nickel sulphate, which is the primary downstream product for MHP, all of this also remaining flat. What this means is all of these increases in prices are getting taken through into the margins. The only increase we saw in price was due to the changes in January to nickel ore quotas in Indonesia, however not due to the actual sulphur impact. I think the primary reason for this is because 𝗂𝗃 plants must operate at quite high rates for cost efficiency, both economic and technical reasons. Economically, there's very high capex involved in an 𝗂𝗃 plant and quite high fixed costs, and so there's a need to maintain running at high capacity rates, and historically we've seen a lot of plants running at above nameplate capacity. In terms of the technical reasons, it's also quite difficult to wind down and start up plants again, so all of this kind of means that it's quite hard to change production rates, and so they don't really want to increase prices too much and have to cut production. Now sulphuric acid prices, however, are becoming too high, and we've seen some significant increases just over the last couple of weeks, but also other parts of the supply chain are converging and putting a lot of pressure singularly on these 𝗂𝗃 producers. So for completely different reasons, there have been changes to the ore supply, which is the second biggest cost now for nickel producers through 𝗂𝗃. So whereas sulphuric acid has changed due to these geopolitical impacts happening in the Middle East, nickel ore prices have increased entirely due to Indonesian domestic policy. There's been efforts to reduce nickel quotas and to change the way that minimum pricing is set for nickel ore, all of which will increase production costs for HPAL producers and an attempt from the government to increase state revenue and capture more value from the metal supply chain, and to boost prices from those 2025 lows historically, and to conserve mineral resources of the future, when hopefully, for the Indonesian government at least, prices will be higher. So all of this coming together to mean that producers' margins have been pretty much completely wiped out towards the end of April, and this is a situation which will continue into the future as we expect continued high sulphuric acid and ore prices. These are things that are going to change anytime soon. So the fact that it's quite hard to pass on these prices to consumers, we expect to see some cost mitigations here. So attempts to draw down inventories and also to push for increased revenue through coal bulk credits, and because coal bulk prices have been quite high historically recently, so increasing coal bulk recovery could be one way to kind of avoid this here. We also expect to see some avoidance of capital expenditures. HPAL plants are highly capital intensive, so we can see some avoidance of project expansions and new ramp-ups. We see a lot of these being delayed, pushed back, or perhaps even cancelled. A lot of this for more macro reasons, kind of been swelling underneath as well. The main demand sector being electric vehicles. The electric vehicle sector has softened from where expectations were, but specifically those high nickel chemistries have become less popular over time. The main demand sector area for those is in North America, and the North American EV market is particularly weak right now, so some more reasons for that. So in the near future we can expect some moderate MHP price increases, but we do think that operators will run through short-term losses. These are locked into offtake agreements, and they have downstream customers, these cathode active materials producers, who don't like cost increases and have a strong tendency to pressure suppliers to avoid price increases. So this is something we've seen happen similarly in the lithium market, where suppliers attempt to increase prices, and there'll be a strong reaction to that from those customers attempt to find new sources and transition away from that. In the long term, we expect to see some margins perhaps moving further upstream towards miners and integrated operations. Major operators and buyers, the people like Huayou and CATL, big CAM producers and battery producers, are unable to gear up on HPAL. There's not really anywhere else to move if you do need to buy nickel for batteries. HPAL is going to remain an important part of this, but yes, to capture more of that revenue, perhaps moving further upstream towards mining nickel and keeping the ore internally within that supply chain. Overall, these high operating costs are likely to lead to moderate price increases and delays in expansion, but not significant price rises and production cuts as might be expected.
This year, we expect that close to half of forecast sulphur capacity will not come online, with many of the projects previously due to ramp up located in the Middle East, including refinery expansions in Bahrain, new projects in Iraq, and gas-based projects in Saudi Arabia. That impact will continue into next year as well, with further reductions likely in the capacity view. A key project to keep an eye on will be Qatar's North Field expansion, as that's going to add over 3 million tonnes a year of sulphur capacity once it comes online, but of course now the timeline is in question. That uptick in 2028 is because of the timeline slipping for projects starting up previously in 2026, 2027 into that period. Even with close to 1.4 million tonnes of new sulphur capacity being added this year in our new forecast, that's not necessarily going to have a material impact on availability. The majority of this supply will not be for the export market. The constraints on crude also pose a risk to the potential ramp-up rates of projects in the refining sector, so we are very cautious on how that could actually translate into sulphur production volumes. The sulphuric acid market is facing a multitude of issues in the wake of the war. Tanker freight rates have increased by 85% on some routes since the start of the year, lower in other areas but still on an upward trend that has pressurised CFR values across key markets. Average month-on-month prices are depicted on the right-hand side for Chile on a CFR basis, with the recent surge pushing up expectations for the year as a whole. Prior to the war, we were expecting average prices to come in at over $160 a tonne CFR for Chile. Now that's been revised up to over $200 a tonne, and this does assume that there would be a correction later in the year. We do see another correction as well in terms of average pricing for 2027. That's in our base case. And on the supply side, we were expecting new burner capacity additions totaling 16 million tonnes for this year. But now, of course, with the sulphur shortage, this is at risk. China and Indonesia are key markets with planned burners that are set to ramp up. The Indonesian nickel sector has a host of projects planned or restarts in terms of burners in the next 12 months that will require significant volumes of sulphur based on the ramp-up phase, and with not enough merchant sulphuric acid in the market to meet that shortfall in sulphur supply that we've seen so far. This brings us to a key factor impacting the short-term view for acid trade. In 2025, global acid trade totaled close to 23 million tonnes. Of this volume, China represented 20%, with a record 4.7 million tonnes shipped. The latest restrictions on exports for China are indicated to run from May through to the end of the year. And that followed the reduction already seen in the first 4 months of the year because of high sulphur prices. Numerous markets have exposure to the tightening of supply from China. Chile, Indonesia, Morocco and Saudi Arabia were the top markets for Chinese tonnes last year. And while India is less exposed, with South Korea leading its supply last year, a substantial portion still usually flows on this route. If we look at the impact on sulphur-based acid production as a result of the war because of reduced sulphur availability, so far this totals over 6 million tonnes of potential loss. A further 6 weeks of the war continuing, with the Strait of Hormuz remaining effectively closed, would push out another 6 million tonnes of potential acid production, unless other sources of sulphur could be found. And that, coupled with this reduction in Chinese tonnes, is going to have a severe impact on an already stretched market. Where can acid supply be found outside of China? The focus is very much on merchant acid availability, but that shift in procurement is further fueling the price run that we are seeing in the acid market. And all eyes, of course, are in Indonesia as well, with the expected restart of Freeport's Manyar smelter later this year, but that will of course provide some relief to the domestic market. We do expect that would take some time as well to ramp up to capacity rates, and even with the short-term capacity increases in smelter-based supply that we are forecasting, that won't be enough to make up the shortfall. China is very much a balancing supplier in the market because of the scale and size of its production across all sources of acid output. As with sulphur, there are limited alternative sources that can replace these tonnes, and the price curve for sulphuric acid will remain firm the longer the war extends, and that really has the potential to then lead to demand destruction across a whole range of industries.